in the modern era, as we introduce telecommunication systems, the telegraph, the telephone, the internet, and all that, we got to a point where our transactions move around the world at the speed of light, and matter does not. And so we used to base our money on gold and various ways to move around gold, either legally or sometimes physically. But in the past 50 plus years, we've completely decoupled from that. And so we exist in a world where there's 160 different currencies, roughly speaking, and they all kind of have their own centralized central bank bubble and capital controls kind of around their borders. And they loosely tie together with their world reserve currency. So in the prior era, they partially tied together through Britain's currency, basically centralizing around London. And in the current era, they tie together around the Federal Reserve in New York. Nigeria and Korea want to do a transaction. That the challenge is what do they denominate that unit in? And for the most part, it tends to be dollars, and both central banks will generally hold dollar-denominated assets. And the problem I think we're running into in the modern time is that after decades of the system, it's built up very large imbalances. And a couple of those main ones are one is the trade imbalances and the net international investment position imbalances. So, in order to supply the world with dollars, the United States has run structural trade deficits. This is kind of a feedback loop that materializes in the system. And so it results in a lot of dollars getting out into the rest of the world, and then the rest of the world takes those dollars and then buys US assets with them. So they buy our stocks, they buy our debt, they buy our real estate, they buy our private equity. And so we end up having a large and larger percentage of our capital stock owned by the foreign sector. That's one kind of imbalance that keeps building. And the other one is that public debts around the world have gotten to very high levels. So Japan's obviously at the forefront of that, but then when you look across Europe, you look at the United States, many countries around the world, they've built up very large public debts, and so they're running into more imbalances on that end as well. They risk running into a fiscal spiral, which is to say that the interest expense on their public debt starts to become untenable. And I think the main pivot point we reached was in the past decade or so, right? So, for example, for 40 years, you had in the United States rising public debt as a percentage of GDP, but it was offset by structurally falling interest rates. And so the interest expense, as both in absolute terms and especially as a percentage of GDP, was not particularly problematic in the acute sense. But after we got down to zero rates and kind of bounced off zero, and now we're going sideways to up, that is no longer offsetting the rising public debt. And so actually, we're getting to the point where interest expense is actually becoming a very meaningful problem. And so that's kind of where the world faces itself fiscally, monetarily, and obviously there's a lot of directions we can go from that point. The national debt clock went up in the United States in the late 1980s. One of the most successful independent presidential campaigns in modern history was Ross Perot, who ran largely on the debt and deficit. That was in the early 90s. That was kind of the peak zeitgeist for the public debt being a problem. Um, but that was also roughly when globalization accelerated. So China connected to the rest of the world, started becoming a cheap manufacturing hub, connecting a lot of labor to Western capital. The Soviet Union fell, and all those borders and trade routes opened up until fairly recently. And so you had kind of 30 years of globalization, which was disinflationary, along with the internet and technologies and things like that. And so we kind of ushered in this era of falling interest rates. And so a lot of people that were concerned around the acuteness of the public debt back then were a few decades early. And so I think now a lot of people have gotten into their view that debts don't really matter, that it can always be pushed away. And I think that's generally the wrong lesson to have learned there, because we no longer have these structurally falling interest rates that they started with back then. Now we have, like you said, well over 100% debt to GDP, and we no longer have a structurally falling interest rate to offset some of that. Instead, I think the main kind of offset or variable to monitor in terms of timing is kind of the overall energy and productivity side, right? So if you have large deficits, ongoing currency debasement, for example, that might or might not show up in CPI inflation depending on what else is happening. If if we're, building a lot of new energy production, if AI is making things way cheaper, for example, if there's all these kind of offsets, these better productivity, better energy resources, better kind of usage of every dollar, then you can get that offset where there's more dollars, but things still are not rising too much on average. However, if you get energy shortages, if AI does not give the rapid productivity growth that some of the bulls think, then you don't have those offsets. And I think that's the biggest variable to probably monitor is what is going to be like the magnitude of those offsets over, say, the next 5, 10, 15 years versus the rate of fiscal spiral and debasement that's happening on the other side of the equation. I tend to lean towards, I think AI is going to be a deflationary force on certain types of wages, especially white collar wages. But that the I'm not as um, I think the energy section is where we could have some material kind of cost increases. Maybe not the next 12 months, but as we get further into this decade, I think that's a realistic concern. In most decades in modern U.S. history, there's two major sources of money creation, broad money creation. That's different than base money. And one major source is bank lending. So when banks make loans, they create more broad dollars. They're basically leveraging up the monetary base at a higher ratio. And the other way to create broad dollars is to run very large fiscal deficits that are then monetized either by the central bank or at least the commercial banking system, basically these other fractional reserve entities. And during, for example, the 1970s, even though the United States was running fiscal deficits, the most of the money creation was coming actually from bank lending. And that's because the baby boomer generation was entering their home buying years. So they started being born in the late 1940s. And so by say the early 70s, they were entering, 25 years old and they were starting to do household formation. And that's a period of greater credit utilization. And so largely due to demographics, you had a bulge of credit growth. There were other decades that were more mixed, but in the current era, a lot of our money supply growth has come from the other angle, which is from monetized fiscal deficits. So it's not that bank lending is excessive, it's fairly muted. Instead, it's very large structural deficits that are not right now, but in the grand scheme of things, generally supported by the central bank or the commercial banking system. And that's where a lot of the inflationary pressures and the money supply growth comes from. And so a lot of analysts have been kind of trained to look at credit growth and credit contraction as the dominant kind of mover of the economy, whether or not we're going to have an expansion, whether or not we're going to have a recession, how much inflation is going to happen or not happen. Is it going to be disinflationary? A lot of that has historically been driven by credit growth, but instead we've kind of gotten past that, and now it's more about the fiscal side. And the last time that the United States was in a similar position was in the 1940s. And so during that whole era, coming out of the Great Depression and fighting world wars, we had very high inflation, we had very high money supply growth. But if you look at bank lending, that was not where it was coming from. It was coming instead from the obvious source, which was large monetized fiscal deficits, which were going to support the war. But then more broadly, they were, you're on one hand you're fighting a war, but on the other hand, what you're doing is you're building manufacturing facilities. You're hiring people to work in those. When the GIs came back from combat, they would pay their tuition to go to, training, right? This is a lot of it was actually spent domestically. And so you had that more industrial policy, fiscal policy type of inflation. And so we're kind of in a similar situation now, with the difference being the types of things we're spending on. Instead of a young population, we have on average a more aged population. And so a lot of the ongoing fiscal support is things like Social Security, things like Medicare, things like still defense spending, obviously. And then for a period of time, we had stimulus checks, we had PPP loans that turn into grants, which were another type of stimulus check. And so all of this has essentially been accumulated fiscal on the economy, which is the bulk of where the money supply growth has been coming from in recent years.